Pineda. The research I've conducted involves Concept 7 in the Statement of Financial Accounting. Before I get into that, let me introduce what the concept is first. The concept shows how to use cash flow information and present value in accounting measures. This brings us to the introduction of present values. The present values of expected cash flows are entirely used in acquisitions, stock analysis, tax calculations, and whenever the future must be quantitatively assessed. It is also expected under this concept that companies prepare financial statements using the same accounting principles as established operating companies. These financial statements are available to shareholders as well as prospective investors. Through this concept, it is understood that it should conform to generally accepted accounting principles, which brings me to the issue. I do not believe this concept should conform to generally accepted accounting principles. Here are a few reasons why I believe these principles are not ideal for these financial statements to follow. First off, I believe these principles are outdated. They were established a long time ago, and I believe we should do away with them. I also believe these principles are incomplete, complex, inconsistent, and irrelevant. I'll go more in depth with these issues, but let me just say these problems are just the beginning. I just believe these should be addressed first and foremost. So, the generally accepted accounting principles were established in 1973. That's over 40 years ago. Within the last 10 years alone, we have experienced a technological boom, which has shifted the way we look at accounting along with how the economy established itself in market value. Not only that, but these principles were created by auditors for auditors, which makes it a little more hard to understand. These financial statements should not reflect what an auditor wants to see, but rather what investors need to see. When an investor is debating on two companies in the same industry, they simply compare financial statements. Back then, it was fairly easy to compare since tangible assets used to be the primary driver in the company's value. Nowadays, a company's market values are predominantly intangible assets. Current publications suggest that overall value of a company is comprised of 80% of intangibles and 20% tangibles. For instance, one study conducted by Ocean Tomo, an intellectual property merchant bank who routinely conducts these kind of experiments, showed that in 1975, tangible assets comprised of 83% of 500 companies in market value, while 17% were intangibles. In a matter of 40 years, we end up with an inverse relation. They found that in 2015 that there was a drastic increase in intangible assets, all the way up to 84%. This becomes more apparent in technological companies whose value is comprised of intellectual capital. Now, speaking in incompleteness, as mentioned previously, intangible assets are more involved in company values. The issue here is that we do not know how much value is accounted for and where. We need a market standard to measure these impacts, but we do not. Under generally accepted accounting principles, tangibles are not industry specific, so we run into recognition problems. Another issue is liabilities. Liabilities can be accounted for. Liabilities can be discounted for companies in trouble. General Motors has been in trouble before. They have been in trouble before. They had large unfunded pension liabilities. To accommodate these pensions, they transferred stock that amounted to $6 billion, and that is ridiculous. That amount is... The point is, this information was not clear to investors, which led to a lot of problems. And how can these investors make financial judgments when it's not clear in financial statements? You just can't trust incomplete statements. Financial statements alone are complex. They contain a lot of information used, and they should be compressed. I find it hard to believe a potential investor would read the entire statement. Shareholder values belong in the future. These principles should be relevant. The current principles are retrospective, and and they fail to account for intangible assets despite their growth in importance. An incomplete report cannot be trusted. Now, on the point of inconsistency, consistency is a huge issue. The main complaint I have is that accountants are able to make their own judgment. This can lead to inconsistencies over a period of time. Fresh start accounting is also not good for capital markets because they interfere with transparency. Just look at what happened with WorldCom. Accrual adjustments have the potential to lead to fraud, which is never a good thing. Accounting and reporting do not provide good measures. They do not incorporate intangibles, which are highly relevant in today's market. This limits the relevance in financial statements, which conform with generally accepted accounting principles. The current accounting model is outdated, inconsistent, incomplete, irrelevant, and complex. Financial statements should satisfy its shareholders. They should also include criteria specific for intangible assets. It would be beneficial to do away with generally accepted accounting principles and create a new set of principles so that investors can benefit from both sides.